Hey, what's up, guys? So today I'm going to show you one of my favorite indicators that I use every single day in my charts. This indicator allows me to not only better time my entries, which is clearly very important, right? But it also helps me to identify explosive move before it occurs. So you want to know what indicator it is? Let me tell you, it's the Bollinger Band. And after this session, you will be adding this indicator to your charts like what I do every day. First off, let's talk about what the Bollinger Bands are. Alright, so to fully grasp this indicator, you must understand that it consists of three main components. The first one is the middle band, which is essentially, typically speaking, it is the 20-period moving average. So this moving average is visually represented by the middle band, right? The upper band and the lower band are positioned 2 standard deviations away from the middle band, right? Which acts as the mean. All right, so in other words, these bands are placed at a distance of 2 standard deviations times 2 in a way, right? From the middle band. So, some of you might be asking, right? What is standard deviation? In simple terms, it's a way to measure how far the market price have moved from the average, right? This helps you to determine how overstretched it is. So for example, when we say something is 3 standard deviations away from the mean, it indicates that the market has moved significantly away, right, from its average position, signaling that the price is quite stretched or extended, right? The higher the standard deviation, the more extreme the price movement away from the mean. Alright, so the higher the standard deviation, the more overstretched the market becomes. So this means that as the standard deviation increases, price moves further away from its average, indicating a more extreme or significant shift in the market itself. So it is important to understand that even if the market appears, say, overstretched or far from the mean, right, in terms of standard deviation, it doesn't guarantee an immediate reversal in the market. No. Right? The market can continue moving in the same direction for a long time, right? We've seen that, right? Breakouts, right? You see the market trend, right? Big drop, big rise in the market, right? So therefore, while the standard deviation helps you assess how far price has deviated from the average, right? It should not be solely relied upon for predicting reversals, like, oh, it's gone so low already, it's going to go up. No, it doesn't mean that way, right? So, but it is a useful tool to gauge market extremes, right? But you got to always consider other factors, right? And the broader market trend before making those decisions, which is something that we're going to show you. Now, common mistake traders make when using the Bollinger Band is assuming that just because the price reaches the outer bands, right, which is the 2 standard deviations away from the mean, right, is a signal to go short, right? They think that the market is overextended, it's ready to reverse, right, just because it's at the upper band. No, right? This could lead to significant losses, right, if the market continues to go higher, which often happens, right, in strong trends, right? So simply reacting to the price hitting the outer band without considering the overall trend is going to result in a lot of losses, right? So that's where you're trying to always catch like a falling knife, right? That's not the way to go, right? Because the market can grind higher for longer than expected. So one key thing to remember is to always focus on the trend. It is crucial to trade in line with the overall market direction. So regardless of what any indicator might suggest, right? So whether the market seems, say, overbought or oversold or overstretched, right? The trend should guide your decision, right? So ignoring the trend and solely relying on just one indicator can lead to a lot of poor trades, right? By aligning your trades with the trend, you are more likely to find better setups and profitable opportunities, right? So avoid the mistake of going short, blindly shorting it just because the price is at the outer Bollinger Band. Always respect the trend first. So now, let's talk about the 3 techniques that you can use when trading Bollinger Bands. Right, the first one, this is called the Bollinger Band squeeze. Right, so this is where the bands start to contract and get closer together. So when you notice that the bands get tighter, especially the outer bands, it signals a period of low volatility. Right, so this tightening is often happens prior to a significant market move, right? Because volatility tends to expand after period of contraction, right? So by identifying the squeeze, you can be prepared for a potential breakout or major price movement that is going to come right in the near future. So as the bands get tighter and tighter, right, they begin to resemble like a squeeze up. I mean, like a sausage, right? Indicating that the volatility, right, is shrinking, right? So this compression suggests that the price action has become more consolidated with fewer sharp movements. So when you see this happening, right, it signals the market is in a low volatility phase. Okay, so that's where it's going to lead to potential expansion in volatility. Right, so that's where the significant move could be coming really soon. Right, so this is telling you like a warning. Right, if you think the market is even ranging, it's usually going to break out. So as traders who trade breakouts, right, as part of your trading system, this is something that we love the most. Right, and adding a Bollinger Band is going to help in that identification. So the Bollinger Band acts as a signal, right, alerting you that the breakout move might be on the horizon, right? So when you notice the Bollinger Band squeeze, you are essentially getting a heads up that the market is preparing for a major move, right? So now the tightening of the band serves as a warning, okay? So now, when you monitor this squeeze, that's where you can identify the potential areas for explosive move in the market. So once the breakout happens, volatility increases. The market will expand, right? And look more like what? Now like a balloon, right? Confirming the market movement. So this is how traders use the Bollinger Bands to anticipate, right, and capitalize on the breakout opportunities, right? So now at this point, the breakout has already occurred. But before that, you would have noticed that the bands were in a sausage-like shape, right? Appearing tight, somewhat horizontal, right? So the band hasn't yet expanded like an inflated balloon, right? For that indicating low volatility, right? So now, this is the early warning sign that the market is building up for the move, right? So the key here is to recognize the tight squeeze phase as it often precedes a breakout. Okay, so the first tip, when using the Bollinger Band for trading, watch for the squeeze to anticipate significant price movement. Cool? Now, second technique is about timing your entries more effectively when using the Bollinger Bands, especially in a trending market. Right, so now you're going to learn all the different phases of the market. Right, so now when the market breaks out of the range now, traders look for previous resistance to become support. Right, hoping that price will pull back to that level, allowing them to go long. Right, however, the market doesn't always provide such a clean retest. Right, more often than not, the price doesn't retrace as deeply as expected, which makes it challenging to enter trades at ideal levels. So understanding how to use the Bollinger Bands for better entry timing will help you navigate around these situations. All right. So what you can do to time your entry on the pullback, right? Especially if the pullback doesn't retrace deep enough to the previous resistance turn support. So that's where you can use the Bollinger Band. So in this case, you can see that if you recall, right, this over here is the 20 moving average. You can see the Bollinger Band, right? So when the market is trending, it tends to retest this 20 period moving average, which is the median line, right? Before continuing lower, retesting, and continuing lower. So for traders, the 20 MA within the Bollinger Band can serve as a valuable trading opportunity. So it often acts as a potential area where the pullback might end, allowing the market to resume the movement in the direction of the trend. Right? So when the market retraces towards this 20 MA, this presents a key area of value that could signal an entry point. Right? So this is where you might look for a trading trigger to initiate your position. So by focusing on the moving average, right, you can now better time your entries and align them with the overall trend. So increasing the likelihood of successful trades. Here's another example. The market broke above the resistance level, right? Then pulled back to retest the 20 MA and then continued to move higher. So it came close to retesting the moving average again before continuing its upward trend. Right, so this highlights the significance of the 20 MA as an area of value. Right, so this is a key level where you can time your entry to trade in line with the trend, using it as a very reliable point, right, for entry signals in trending market. So what is best extra tip is that when price reaches those levels, you can add price action, candlestick formation at the areas, bullish engulfing patterns, for example, at the areas for buying entries at this area of value. Now, the final tip about using the Bollinger Band to ride big trends effectively. Applying the same concept of the 20 MA, you can use it to trail your stop loss. So now this strategy involves staying in the trade as long as the market remains below in the downtrend, below the 20 MA in a downtrend, or above if it's in an uptrend. Alright, so you would only exit the trade when the market breaks and closes above, right, if it's in a downtrend, or below if it's an uptrend, the moving average depending on the trend direction, right? So this allows you to capture really big moves, larger trend, right? Giving your trade enough room to breathe because you're trailing it, right? Because there is always going to be retracement pullbacks in the market, right? So this allows you to give enough room to trail for an insane RR. All right, so it allows you to don't exit the trade prematurely during small pullbacks and maximize the full trend potential. So this is the idea of letting your wins run while you manage your risk along the way. So that's where even if it does reverse, you already captured a great profit using the trailing stop loss. Cool? Another method, if you prefer to give your trade even more room to breathe for bigger trends, you can trail your stop loss using the outer band, right? The outer Bollinger Band, right? Instead of the mean line. Right? So in this case, you will only exit the trade when the market breaks and closes beyond the outer Bollinger Band. So this allows you to have like a wider stop, allows the trades to have more flexibility, especially doing minor price fluctuations. So it increases, by doing this, increases your chances of capturing longer term trend, right? As you're allowing the market to move more freely within the band. Because the market doesn't just drop, right? The market can drop, pulls back, drop, pull back, drop, pull back, right? So sometimes you can trail it, but if you see that, hey, based on the past history, price tends to pull back a little bit more than the median line, so that's where you can move it up towards the outer band. So now let's recap. Number one, it's always important to align your trades with the overall market trend, whether is it up or down, right? Trading against the trend is often lead to poor results, right? So as the market can continue in the same direction for longer than expected, right? So following the trend would improve your chances of success, right? Number two, when the Bollinger Bands tighten, what does it indicate? It indicates low volatility, right? It signals what? This is the best part. It signals that a breakout is coming, right? So this period of contraction is typically followed by sharp price movement. The longer the contraction, the more powerful the breakout is going to be. Number three, the 20 moving average, which is the middle of the middle band, often serves as an area of value. So when price, when it's trending, retraces to this level, this gives you good entry points to trade in line with the trend. Number four, to maximize your profits while managing your risk, that's when you can trail your stop loss along the mean line or the outer Bollinger Band. So the mean line, which is the 20 MA in this case, offers tighter control, while the outer band gives the trade more room to move, allowing you to capture bigger trends. So thank you so much for watching. If you enjoyed this video, please give it a thumbs up, right? It really helps to keep the channel growing. And if you are new here, don't forget to hit that subscribe button and turn on the notification bell so that you never miss an upload. So we also love to hear from you, right? Drop a comment below and let us know what you think or what you'd like to see next. I mean, your support truly means the world to us. It keeps us motivated to bring you awesome content every week. And if you're keen to learn more, I've created a free 5-part comprehensive training where I show you exactly how I trade using my lifestyle method. Link in the description below.